Oh, we are recording. Thank you very much. Welcome, everybody. It's 11:59. We have about 37 seconds till we hit high noon, Zeb, and then we'll get rolling.
Get ready
Welcome
to
to the
go.
Investment Forum.
There you go.
Okay.
Mark McCarron, you're very far away at the end of the room now. Did you know that?
It continues to shift. Yes.
Like the investments in the wind. Okay. As long as you know, I'm fine with that.
We'll fix it. We'll fix it.
Beth, Karen.
Yeah, that's fine.
Carol, do I hear you?
Hey, it's Stephanie.
It's good to meet y'all. And Zeb, how about we get going?
Yeah, great. Good afternoon, everyone. My name is Zeb Davenport, and I serve as the chair of the Chester County Community Foundation. We're excited to be here, excited to have so many folks here with us. Looks like we have about 48 people on the Zoom, so thank you all for Zooming in. Would ask you, though, before we get started, if everyone could put their cameras and microphones on mute, that would help us. Obviously, if we have questions and answers when we get to that point, but if you're just zooming in, if you could put your cameras on mute, your volume microphones on mute, that would be greatly appreciated.
But we want to see their faces on the camera.
Absolutely. You can certainly turn your cameras on. That'll help us as we engage with everyone. We encourage you to keep your cameras on. Love to see your smiling faces. In fact, the speakers get energy from seeing your faces. We've got some wonderful speakers lined up. I'm looking at you, Mark, and folks. So like to thank you for turning your cameras on. Quickly want to run through the agenda. We're going to do a quick welcome. That was the welcome. Then we're going to have a little bit of an update by myself. I'm going to talk a little bit about the Community Foundation. Karen's going to do a little bit of a discussion overview of our programs, and then we'll turn it over to Mark and the rest of our folks to provide you with a wonderful session for today. Literally, you folks should know, if you don't know, we at the Community Foundation, Karen, you can click it down to the next slide there. We value connecting people who care, and this is our mission, and I'll talk about this again, but connecting people who care with causes that matter. So their philanthropy makes a difference both now and forever. And so and I also want to thank our ever vigilant board members. These folks give of their time, their talent, and their gifts, and they're always available. And we value each and every. We have got some of our board members on the Zoom today. Some of these faces you may know, some you may not know, but these are all great folks. And so we want to thank all of our board members and our emeritus board members, whether you be present or in your absence. We just want you to know we appreciate the support. And as I said earlier, our mission is connecting people who care with causes that matter. So their philanthropy makes a difference both now and forever. And our vision is simple. It's straightforward. The Chester County Community Foundation is a philanthropic catalyst for positive change, strategically and intentionally engaging donors and partners to address the common good, transforming our region into a better place for all. Our main focus is to make this place a better place. We want to leave it better than we found it. And anybody who connects with our foundation, we believe you do the very same thing. So we thank those of you who are connected with us, even in your philanthropic efforts. So thank you for that. Now, real quickly, at a very high level, I want to talk about our core values. We have 6 core values, and under each of those values, we operationalize what those values mean. Very simply, passion, accountability, collaboration, inclusion, proactiveness, and responsiveness. Those are our core values. And it's centered around this concept of philanthropy. And Karen has so graciously provided the Greek translation for philanthropy, but I will tell you, it just means the love of humanity. And so from that space, do we operate for those 6 core values? Passion. We're in, okay. That's right. That's right. I don't need to go through it. Thank you. You just saved me from having to read those core values. But folks, you can take a look at them on our website. And our overarching goals, again, simplistic yet complex. What we want to do is make sure that we have an institution that is stable and sustainable, and that we also work from that perspective. And if you see the center of institutional stability, the arrows go in and out, up and down, and they're connected by a circle because we believe all of these things work together. We want to provide for our community needs. We want to serve as leaders and advocates, bringing people together, institutions and resources together. We want to be able to grow philanthropy, deepening the passion for philanthropy and inspiring others to engage and become donors. We want to make sure that we take care of the nonprofit community by providing resources that strengthen the nonprofit community and their capacity and impacting sustainability. And finally, in this web, we talk about being fund advisors and serving fund advisors and donor services by providing exceptional services for donors that cultivate inspired giving. So I just very quickly at a high level ran through who we are, what we do, why we do it, and why we continue to do this good work for the folks who are on this call, for people like you and folks who are in need of our services. So thank you very much. And with that, I'm going to graciously turn it over to Karen Karen Simmons for the next step.
Thank you, Zeb. So on a programmatic level, how do we do what we do? Let's just quickly go over, we have some core programs. The Community Foundation is about long-term charitable philanthropy. We hold and trust over $118 million for over 400 different funds. So many of you fund advisors are here today, whether you are a nonprofit that has an endowment, whether you're a family or an individual who has chosen a specific field of interest, like a special geography or a special cause, arts, culture, heritage, environment, whatever. A lot of our fund advisors have endowed donor advised funds so that you can make grants to causes that you care about, and you can change your mind every single day on the different causes and add to it. About a third of our funds are now entrusted to the Community Foundation. People have decided that they want us to make those grants for them, and the grants committee works to do so. And then scholarships, about 7% of the funds that we hold in trust are scholarship decisions that we make with guidance counselors and with community groups in line with IRS regs. So these are all about long-term gifts to the community so that there is a bunch of charitable money to fuel the sector day in and day out over the years. We work with families and individuals throughout the community to help them discern what they care about the most and to do some smart grant making over time. We also have giving circles and grant panels so that if people aren't ready to start a fund, but they want to kick the tires a bit, that's a way to understand how we work with people and the due diligence that we also undergo with our grant making. And if you're a nonprofit, we want to help you grow your endowment fund by planned giving and major gifts. And we have a range of services to help get the word out, to help provide ongoing training, individual coaching, making some capacity building grants, and actually helping you implement your planned giving over time and helping you with those more complex gifts. So those are our core programs to help grow legacy philanthropy. So there's always a pool of money to help charities throughout the region forever. That's what we are founded to do, and that's what we do, for good, for all, forever. Last year, we granted out about $5 million in funds. It's all dependent on the grants and scholarships awards made by the families whose funds we hold in trust. So these are the various interests, and you can see the causes are great. We help people understand what's going on in our backyard of Chester County, and grants and scholarship awards can be made any place throughout the United States. But about 3/4 of them stay within an hour or so of where we live. So all kinds of causes, all kinds of grants and scholarship awards. And these are the list of the funds we hold in trust. And many of you are here today. Marge Miller and Art Miller, I think you started one of the first funds, and it wouldn't be the same if you weren't at the investment forum. So thank you for coming in from Shenandoah. So whether we go back to 1994, 5, 6 when we started, or whether it's somebody who just started a fund this week, thank you very much. I know you're on the call too. We hold over 400 funds in trust. Again, these are the nonprofit endowment funds and field of interest funds. And you can see that there's a range. Scholarship funds so that people can have a hand up, not a hand out. Education is the key to success. So we adore working with families and we adore working with individuals to make your philanthropic wishes come true. And where there's a will, there's a way. We have over 200 people who are in our Ben Franklin Legacy Society. It's named after Ben Franklin because we actually have some of Ben's money from his original will. So that was our very first endowed fund at the Community Foundation. So thank you for all of you who are a member of our Ben Franklin Legacy Society. It seems like you join us and you get to live forever. So that is a terrific thing. And with that, very brief overview of what we do overall. I'm going to turn it over to Mark McCarron, who chairs our investment committee. Thank you, Mark. Mark is at Westcott, and I think, Mark, we got the close-up face, and once in a while you're going to go to the long view, so whatever it takes.
Yeah, thank you, Karen. And there's the long view. I'm just gonna hope the camera in this room finds me so I can come up closer, and there I am. First of all, thanks very much for attending today's investment forum. It's always an interesting time to get together and think about the big picture, about what's happening around us, what's happening in the past year. And we've got some great partners to work with today to talk a little bit about what they see in the future. But before we get into that, just a quick reminder, I'm chair of the investment committee, honored to do that. And as the investment committee's role really is to coordinate really with the foundation and also bring oversight to our partners. And we are accountable and responsible for, apologies for this, responsible for overseeing the investment policies, which means what is the right asset mix in the portfolio. And that's the asset allocation and whether that mix is appropriate to meet the current short-term and long-term goals. We also want to ensure that we have a good accounting of performance reporting and making sure that we have a sense of what that looks like today. And as markets change, we make sure we're evaluating the impact on the portfolios. As Karen mentioned, I'm going to try something different here. As Karen mentioned, we are entrusted with your assets and your focus, and we want to make sure that it has the ability to grow over time and deliver those long-standing objectives that you've put forward. And we think about that in the context of a return, what the return should be in that portfolio. We have two main objectives or two main benchmarks. One is to achieve a minimum financial benchmark. And that is a combination of what the spending rate should be over the average of the last 5 years, over and above inflation and administration fees. And we'll talk about inflation, I think, quite a lot in terms of what the impact is on not only growing prices in general, but how does the investment portfolio fare as inflation grows? And we can talk a little bit about that. The other objective is to manage risk, and manage risk is over the long term, ensuring that any market volatility is well balanced. And if that balance is correct, we get through that period of volatility and then off to achieving those long-term objectives. So as the next slide will show, we do that in a couple of ways. The investments and the allocation, again, is set by that investment committee. We have on the right-hand side sort of a combination of what we have in the endowed funds, and we think about this in the context of what part of the portfolio is designed for growth, what part of the portfolio is designed to generate income, and then the small sliver there, what else in the portfolio can we put in there to help us diversify some of the risks associated with markets? And on the left-hand side, that chart just shows really a mix of how the portfolio is allocated today. The largest allocation today remains the US stock market, followed by international and emerging market stocks. But then as you go around the edge, we have other asset classes, asset categories that are really there for other purposes that, again, either diversify risk or generate income, or both. And we measure each one against a specific benchmark, but we really think about the world in the context of the total portfolio, the total picture. And it's that really big long-term thinking that our investment committee does that it really makes a difference in terms of what the endowed funds do over time. So with that, I'll turn it over to speak.
Oh, could you speak about the model a bit?
Sure.
The aggregated and the separately managed accounts?
Absolutely. So
Thanks, Mark.
sure. We have a couple of different models, as Karen mentioned, with funds in the program. And we have an aggregated investment portfolio, which is the majority or the largest component of the funds that we oversee as the investment committee. That breakdown is shown there as of the end of last year. Hurd O'Callaghan, our partner who will be speaking shortly, oversees that, and what their role is an outsourced chief investment officer. So the investment committee will work very closely with Hurd O'Callaghan, who've been long-term partners of the foundation, and they are given a mandate and are reviewed on a quarterly basis to ensure that the portfolio is being managed in line with expectations. There's another option available that's on the separately managed accounts. We call that the Medallion program. And you'll see some photos there of some of the representatives here today on the call. There are representatives from Truist, from Phoenixville Federal, from Merrill Lynch, from Vanguard Creative Planning. These are partners that are vetted by our investment committee, but are selected by our donors. So we will ensure that the funds allocated to those partners are also reviewed, monitored, and evaluated over the long run. And you can see those assets are broken down by each individual Medallion partner on the right-hand side of this chart. So those are the two choices, if you will, options that our donors have when they come to work with the foundation. And what we'll start with today is really a presentation, an update from our outsourced CIO partner, Hurd O'Callaghan. And then we'll follow that up with a Q&A with all of us, including the Medallion partners, to answer those questions that you might have on what's going on out there. We might have some of those answers, but our best bet in terms of how what's going on out there does impact the portfolio and the way we manage. So with that, I will turn it over to maybe back to you, Karen, to.
Oh, well, let's just turn it right over to Chris and Nick, and you guys can figure it out. And
All
thank
right.
you, Mark.
Yeah,
You
thanks,
stayed
Mark.
stable.
Thanks, Karen. Yeah, great. It's really great to be here with everybody today. We get a chance to talk to all of you once a year, and sometimes you have a year like 2022 where it seems like the world's collapsing. And 2024 was such a great year. So just quickly, I'm Chris Valerio. You're going to hear from Nick Fazzi in a second, the portfolio manager, but both of us work actively with Karen and Bob and the rest of the team, obviously on all the integrated parts of the relationship. And then we work very, very closely with the investment committee. And I'll talk a little bit about that in a second. But briefly about Hurd O'Callaghan, we've been doing the same thing we continue to do since 1988. And that is serve as the Community Foundation's Chief Investment Officer. It's our only line of business. We don't do investment banking. We don't do mortgages. We don't do insurance. It's literally to act as a CIO, and I'll talk a little bit about that structure. We've got 100 professionals, of which 85 are headquartered right here in Conshohocken. And if you look at our client relationships, it's about 200 roughly, half dedicated to the institutional channel, which is foundation endowments. Obviously, the community foundation fits into that. And then family groups. A lot of them are related. Somebody will sit on a board, then hire us to manage the personal money, or vice versa. And we do have 20 billion under management. We're independently owned. And I think the biggest part of this is just having zero conflicts of interest, which means anytime we bring an idea to the investment committee, and anytime we think about the fund donors and driving returns or thinking about controlling risk, like Mark had mentioned, we're not going to do it with leading with a product where we're going to get compensated. We strictly have one fee. So it creates this, what I kind of feel is this just beautiful alignment between us and the fund donors and the community foundation. So maybe the next slide, and I'll just talk a little bit about that structure. So as everybody knows, in your day work, your board work, whatever you do, getting the governance structure right is really, really important. So let me just spend a minute on how important that governance structure is. So if you think about the fund donors, then it drops down to the board that are basically entrusted with managing this money, your money, on a full-time basis, and having a fiduciary lens, right? Doing things that are prudent, thinking long-term, and then that rolls down to the investment committee. The investment committee has hired us as the chief investment officer with a dedicated investment plan that Mark had talked about, how much in US equities, how much in private equity, that whole structure. And then our job is to implement it. And what does that mean? That means to go out and find what we think are the world's best investment managers and allocate capital to those investment managers, fire them if they're not doing their job, make sure we've got the structure of the portfolio right on a long-term basis. So that discretion falls down to us to operate within the overall investment, which means we have day-to-day point accountability. Nick and I are constantly looking at these portfolios, rebalancing if we have to, thinking about risk. And we really view ourselves as an extension of the staff and an extension of the investment committee to think about that overall structure. And then we report results back to the committee. And as I think I joke on this committee, on this call every year, it is a very intense meeting. I can tell you that the investment committee is made up of some great investors that ask very deep questions. So we have a very collaborative and deep discussion on markets and managers and positionings. And I think for all the fund donors on this call and everybody else that's referred money in via fund donors, know that there's very, very active discussions going on to have the oversight of this portfolio. Nick, why don't you pick it up and talk about the good results last year?
Yeah, thank you, Chris. And just my way of background, at Herbal Callahan for about 20 plus years, working in the portfolio management group. I'm a member of the investment policy committee, and thank you to everyone that's joined. 2024, I think, caught a lot of folks by surprise with how strong the equity markets returned. And this was a phenomenon that we saw particularly in the US markets, as this underlying AI theme that is really driving US portfolio results really surged once again. But it was volatile along the way. And so we saw a brief drawdown in the summertime period. But ever since the election, this theme of narrow stock leadership continues to drive forward off the backs of very strong earnings that have been delivered, but also looking forward some pretty optimistic expectations for forward earnings growth. And this was a theme, once again, that was primarily in the US. So outside the US, international stocks and emerging market equities, lagged, particularly in dollar terms. And, when you look at the positioning of the portfolio, we have a slight tilt away from some of those areas in the market, particularly in the US, that we feel are a tad stretched from a valuation perspective. I think the other thing that is readily apparent, and this is a theme that has really gained momentum since COVID, has the idea of interest rate volatility. So we saw interest rates normalize post-COVID when we had negative real interest rates. We saw a dramatic reversal in the 2022 timeframe, and then interest rates steadily climbing since that time. But this year was another volatile year for not only expectations, but also how the Fed and central banking policy is responding to that inflation threat that we talked about earlier in the presentation. All this made for a pretty decent year, driven by risk assets, and you can see the portfolio positioning at the bottom of the page, where within the equity portfolio, we're tilted away from stocks that we think carry some valuation risks. And how we're implementing that is through some exposure to low volatility stocks within the U.S. equity portfolio. We've also leaned into international equities, particularly in Europe, which was a slight headwind for portfolio results in 2024, but that's flipped on its head and is really leading the way at the start of the calendar year here in 2025. The other area, once again, within the fixed income portion is we're to a neutral weight and duration, but we have an emphasis on treasury assets as a means to provide that ballast within the portfolio should we see some sort of hard economic landing or continued equity volatility. And Mark, I think it did a great job of unpacking that, but the overall portfolio positioning is right around 70% or so stock orientation or equity beta. Once again, with the eye towards growing the portfolio above the spend plus inflation as a means to get access to that earnings horsepower and really to grow the portfolio. Within the equity portfolio, I think I talked about our positioning in terms of being slightly more defensively oriented. We do have some active management in the portfolio, primarily in that fourth line item down, where we get access to managers who are much more fundamental stock pickers, much more concentrated in nature, but a good portion of the portfolio is passively oriented to not only pass those fees along to you all in terms of cost savings, but also to capture the market in a pretty efficient manner. Okay, and then the next slide in terms of performance, once again, I think 2024 was a decent year, you know, up almost 12% or so, slightly behind a benchmark. What we try to do is give a cost to capital approach, the benchmark being 70% stocks, 30% fixed income. And once again, the main headwind there just being slightly tilted away from US stocks and slightly tilted away from growth stocks, which we think carry higher valuations and some valuation risks going forward.
Now, this is also a chart for the quasi funds. You want to explain the difference, Nick?
Yeah, so we also manage the quasi and down funds, I think, as a means to accessing a portfolio that carries a different risk profile. So the first thing that I think jumps off the page here is that growth exposure or that equity orientation, which is about 20 percentage points lower. So it's a way to reduce volatility, get access to more fixed income, a more narrow distribution of outcomes, and relative to sort of 3 to 4 years ago, we have fixed income yields from our perspective delivering good ballast, good diversifying characteristics, but also that yield that I think many of you who are invested in this portfolio rely on as an alternative to a more equity oriented portfolio.
Thank you.
Okay, and you can see the returns there a little bit more muted relative to the equity dominant portfolio that we talked about.
So let's talk about some overall.
Yeah, I think Chris and I chose this slide just as a way to show the investment committee one of the lenses which we view the environment through, and that's a valuation lens. And so if you're thinking about your own personal portfolios, the assets that you have entrusted to the community foundation to manage, one of the ways to do that is to look at it through valuation. So you can take the price that you're paying for an index today and divide it by the forward expectation for earnings for that index. And it's one metric that the industry uses to standardize or an attempt to standardize valuations across the globe. And you can see here what you're looking at is various subcomponents of the overall equity market, the US market, the European equity market, the emerging market equity markets, and then China, and looking at the range of price to earnings ratios over the last, call it 15 years or so, 20 years or so. And what you can clearly see is that the US markets are trading well outside their normal range over this time frame, especially relative to say, the European indices or the emerging market indices. And that's not just to say that we look at valuation on a standalone basis, because the US trades at a premium multiple for a variety of good and legitimate reasons. But today, I think given where things stand, this is one factor influencing us tilting the portfolio, once again, on the margin, away from certain pockets of the US market that we think are a tad overvalued. Okay. And then this slide then tries to standardize that for growth. And so if you can see that the US should be trading at a higher multiple, and we certainly can see that, the earnings expectations or the growth and forward expected earnings is another way to standardize that. And so when we do that, you can see what we put on this slide is the Mag 7, which changes all the time depending on how Wall Street wants to characterize these stocks, these high-flying stocks. The rest of the S&P 500 in totality, which is the blue line, and then the stocks 600 Europe index. And you can see when you standardize for growth that we still feel that European stocks give us not only a margin of safety, but the ability maybe to pick up companies that are global in nature, that are high cash flow businesses at very attractive valuations on a relative basis. And I think the last slide here just goes to show you the resiliency of the US markets and the fact that the returns that we've seen, particularly in stocks driven by, from our perspective, a very singular AI theme, artificial intelligence theme, the earnings growth has been very, very strong. So the returns that we've seen, not only through investor euphoria associated with this phenomenon, but the stocks have delivered in terms of their earnings. I think what gives us pause, just looking forward, and the 2024 number there largely baked in, this is somewhat of a dated slide, but looking forward, the earnings growth that is still, I think, being forecasted from analysts is just a tad rosy from our perspective. And so we would choose, and we are on your behalf, to just tilt away from this theme in, I think, a somewhat prudent manner, with the idea that if these earnings do not come through, or there's some sort of external shock to the system, as we saw at the beginning of the year with the DeepSeek news, when the CapEx expenditures of some of these larger companies were called into question, we just want to be tilted away from that factor, once again, in a reasonable manner, to pick up other pockets of the market that we think are more appropriately valued.
Mm-hmm. And now, Mark, back to you.
Back to me. Well, thank you, Chris and Nick, for that overview. I think it's very helpful. And just to reiterate what Chris mentioned at the beginning, we work very closely with Hurdle as our outsourced CIO on a significant amount of the assets entrusted to the foundation. But we also have great relationships with other medallion partners, other firms, where we also have those great relationships in terms of understanding what they're doing portfolios and how they're positioning. And so we thought this Q&A session could start high level, big picture. And we'd like to invite some of the other members, both Hurdle and some of the medallion partners, to weigh in on what they see out there in the marketplace. And then we'll open it up for your questions as well. But just, maybe there's an overall question here. I'll take a stab at it, but it's always a good reminder. What we're talking about here is money entrusted to the foundation. And that foundation is an institutional investor versus a personal investor. So what's the real difference between that? The foundation has a very long time horizon, multiple lifetimes, if you will. And as a result, we think about risk and return in that very long-term context. And that allows us as an investment committee to set the strategy with a gear or tilt toward growth investing, growth assets, such as stocks globally. And that does come with some risk in the short term, but we think over time, those assets will grow faster and farther with that particular tilt. And I think the other nuance here, what the differences are between an institutional investor and a personal investor, maybe personal investors get a bad rap as being emotional and quick to make decisions. We try to protect against that risk, right? Working with our committee members, which are in the industry, but also with our partners here on the screen that you see, to ensure that we're not reacting to any short-term news and noise and headline risk, which, by the way, there's quite a lot of that today, this year.
Notice that.
Yeah, there is. And we'll address all of that. So I think, for those of you who joined us last year, we talked about the economic environment, the market environment. As Nick just mentioned, 2024 was a very good year for stock markets and a pretty okay year for bond markets. But if you look very specifically, it was really US centric. Again, it was a US stock market leading the way. And so one of the key themes that have been with us the last couple of years has been a post-COVID inflation problem. So after COVID, inflation picked up quite a lot, and the Fed has been battling that higher inflation for the last several years. First, by raising their interest rate, the interest rate. What that does is makes things expensive or makes borrowing expensive, slows the economy down a little bit, but not too much. So this idea of having an equilibrium in the economy is what we're referring to here as a soft landing. So not too hot, not too cold, but just right in terms of economic growth, in terms of inflation, and in terms of unemployment, making sure that we don't cause a recession out there. So the first question is, have we achieved it? Has the Fed achieved it? And have the markets returned to that equilibrium, that normal? And I'll start with turning this over to Nick, to give your view, and then I would invite some of the other members here to join in as well. But turn over to you, Nick, real quick.
Yeah, thank you. I think from our seat, I think a lot of people out there were waiting for this earnings sort of shoe to fall off and the equity markets to respond in kind, and that just hasn't happened. So one of the questions is, what do we learn? I mean, the idea of trying to market time any sort of risk profile to take advantage of a perceived maybe weakness or a hard landing that isn't priced in, that's a very difficult thing to do. So I think hats off to the committee here who takes that long-term lens, recognizes that having a diversified portfolio is sort of one shield against equity market volatility. But looking forward, I think the picture is sort of cloudy with the idea that I think the central bankers are very concerned about a resurgence in inflation. And you've seen their commentary and more of a hawkish turn sort of reveal itself, right? So, the market expectations for interest rate cuts sort of has dramatically changed from where we're at to the start of the year. I think there's a recognition that the economy continues to remain resilient. But I think if we're in an environment where interest rates need to be and remain elevated, that could put a dampening effect, I think, on what we've seen so far. So I think that's the Fed's major concern. It's one of the major concerns from our standpoint. But so far, not only the consumer has held up reasonably well in the face of unbelievable inflation, in the face of higher interest rates for a lot of revolving credit, mortgages, et cetera, and earnings have been extremely strong for many of these companies. So I think that's why we're just a tad cautious, given how far the equity markets have come. And that's why we're tilted away into things that I think could give us a better margin of safety while still being on your overall equity sort of target.
Yeah, thank you. And I might just ask our friends from Truist, if Diane would like to just give their thoughts too, because I think there's a lot of opinions out there on the market in terms of whether we have or haven't. So it may be among this group that we have some different perspectives. But what are your thoughts, Diane?
Yeah, thank you, Mark. Good afternoon, everyone. I'm Diane Mangus, Senior OCIO Investment Manager with Truist Foundations and Endowment Specialty Practice. We're really honored to be a Medallion partner, so thank you for having us. Nick touched on such important concepts, uncertainty being, probably the largest. So when we ask the question, has the Fed engineered a soft landing or are we in a soft landing? Probably depends on what time of day you look. And by that, I mean, today, I think we can comfortably say, yeah, things are pretty good. We had an above average US growth rate last year, 2.5% is about average, and we exceeded that, 2.7 or 2.8%. The US economy grew. The consumer, all of us on this call, if we put our consumer hat on, we're incredibly pivotal to the expansion. We have money, we spend money. And oh, by the way, with that inflation that Nick talked about, it has come down to a level, it's in the high twos, so it's not ideal for the Fed, but it's rising less than we're earning over the past year. Average hourly earnings are above that, closer to 4%. That's the rosy picture. The what shoe could drop is everything that we see in the headlines. Fiscal policy is uncertain. It's changing dramatically day to day, hour to hour. And so Nick and myself and others who are responsible for managing investment portfolios, we're looking at the implications on inflation and on the consumer and on corporate world coming from tariffs and the labor force, if immigration laws change. So it really remains to be seen. We could be here next year at this very time and say, gosh, the soft landing was, we didn't achieve it. But as we sit right now, it seems like maybe we have achieved it.
Yeah, it's an interesting point, and it's maybe temporary, whether it's soft landing now and then something changes in the future that disrupts the trend. And I think the next two questions on this slide are just remnant or good examples of that, what the fiscal policy could be from this current and second Trump administration, and what trade wars and tariffs could do to the global stock and bond market. So any volunteers for this one? I'm looking around. I think I see John and Jack and others. Maybe turn it over to Jack. I'll ask you if you want to give your thoughts on the big picture, the political headlines, if you will, and what you see.
Well, I appreciate the question. I almost want to pump on this one, to be honest, because it's one of those where anybody's guess here, quite frankly, because it seems to change by the week, if not the day here. But there seems to be very binary sorts of views here as far as policy, particularly fiscal policy. You're either uber bullish as a result of potential deregulation, tax cuts, et cetera, or you're uber bearish here, fears over tariffs and trade wars and whatnot. In our view, we parse this in many ways in many reports over the last few months. In our view, quite frankly, while the range of outcomes is probably wider than ever, we have a fairly balanced view, because for every one of these potential negatives, there's a positive. So for example, in terms of tariffs, could that raise prices around the world? Potentially, but it depends on what currencies do, and it might result in more reshoring investment in that country. Same thing as far as corporate tax cuts. What does that do? Increase margins potentially. It might involve overseas companies moving operations back to the U.S. because of the lower tax rates in this country. But quite frankly, I think our view is more balanced there. I think, as Diane mentioned, as Nick mentioned, I think right now the economy is in pretty good shape, pretty solid footing. It's tolerated the higher rate environment pretty well here. And quite frankly, the rates are more or less normal if you look back at the longer periods of time. So from our lens, I think we're positive. And keep in mind, we're talking about investments in portfolios. The economy is not the market, right? So we focus more on earnings earnings growth, interest rates and direction of interest rates and that sort of thing. For us, the stars are aligning pretty strongly for a good growth this year. We're overweight equities. We are selective, as Nick pointed out, valuations. If you look at U.S. equity, particularly the S&P, it's pretty rich. But if you drill down and look at, within the S&P, maybe smaller mid-cap stocks or some of the traditional sectors of the economy, industrials and banks and healthcare, there's opportunity there as well. We do like international. We would be very selective there. But all in all, I think if there's one thing about Trump is that he does pay attention to the stock market. Right? So if the market's not doing well, chances are he'll shift gears. Right? So we'll have to see. And then there have been many cases where he's put out a very extreme position only to walk it back, or someone in the case walk it back. So we're focused on interest rates. We're focused on corporate earnings growth. We're focused on consumer spending. And for us, all those will fairly positive.
Yeah, thank you. And John, what are your thoughts in terms of these big themes that could disrupt where we are today?
Yeah, the impact that I think from what I've seen so far and what we've talked about is actually the deregulation aspect of it. It does seem that we will probably see some sectors in some areas of the country being deregulated. We're seeing it actually now in financial services, the proposed ideas of deregulation in the banking system, which actually, so far, we've seen about a 7% jump in just the financial sector on that belief that we're going to see some deregulation. So I think that's the aspect that we're seeing that could be a positive. Going back to the consumer aspect that we talked earlier, I think our concern is when you looked at consumer spending in 2024, it was driven by the high-end consumer. So our concern is as you continue to have a higher interest rate environment, housing difficulty in terms of cost, you could see the middle and lower income consumers suffer, which actually we believe could push us more towards of a hard landing versus a soft landing.
That's interesting. No, there's a lot of moving pieces out there, and you highlighted sort of the other sectors in the market outside of artificial intelligence that might have a chance. The last couple of years, it's been really focused on that. And I think we have some members of the Phoenixville Federal on here. Maybe we can just turn it over to Phoenixville. Just talk a little bit about whether the trends that we're seeing in our AI and artificial intelligence, is it sustainable, or are you also seeing a broadening of the market?
And Kurt, you have with your team, you have Kurt Kunch, Donna Ziev, and Morgan with Addison. You want to talk about the relationship as well?
Yes, thanks. Go ahead, Morgan.
Awesome. Morgan Freeze, it's great to meet you all with Addison Capital. I believe my partner, Steve Benjamin, may also be on the call too. But if he's not...
Is that Steve's iPhone?
Not sure.
Not sure either. Sorry, Morgan.
Okay.
Go with it.
So certainly, I think AI has been the topic of conversation for the better part of the last 2 years, and this is certainly an area that we remain convicted in and around, not just specific to AI, but really the infrastructure and the power that looks to ultimately power all of this going forward. I ran a couple quick stats on this. So as it relates to overall contribution to the S&P's total returns last year, AI-related stocks brought in about 30% of those overall returns. So certainly an impressive part of the performance of last year. And really looking forward, global spending in the space is projected to reach about $300 billion this year. So that reflects a pretty significant CAGR across the past few years itself. There's been no doubt a lot of recent news I'm sure we've all seen on the news, specifically around some upcoming infrastructure investments and things like the Stargate project, where ultimately we're looking to, as a country, invest up to $500 billion in AI infrastructure over the next 4 years. But really, I think a couple interesting facets to all of this are how companies are looking to leverage AI and whether or not open or closed source models ultimately lead to the most innovation across the board. But ultimately, we're of the belief that AI and its ultimate rollout are going to certainly lead to deflationary impacts across the board, as well as increased valuations across tech-focused equities. Just a couple other interesting dynamics as of late. I think certainly we should be mindful as market participants of regulatory developments, specifically around ethical considerations around how this is getting rolled out, which could certainly impact some of the trajectories of these AI-related investments. And additionally, within the last couple of weeks, even we've seen some newer developments in the space. I think that earlier DeepSeek was mentioned. We're of the belief that that sort of created a bit of a Sputnik moment in terms of what this AI arms race will begin to look and feel like. And that will certainly continue to drive a lot of the volatility and conversation around overall demand in the space for all elements powering this revolution, right? Whether that's chips, whether that's the power generation itself, the delivery lines and mechanisms to get it to these data centers. Again, all of that I think is going to come in the coming weeks and months as we learn more about ultimately what those solutions are. And as recently as today, what some competitors such as Grok through Elon's X is ultimately delivering to the market.
All right, Morgan, I see Marjorie Miller and Art Miller smiling like crazy as you're talking. Marge and Art, you have something to say, don't you? You have to unmute yourself. You have to unmute yourself, Marge. Morgan, I think they're stunned and impressed. So that's what Marge is saying. Yeah, a Sputnik moment. Yeah, that is fascinating to have you refer to that. You want to explain that a bit?
Yeah, I think as it relates to overall how these U.S. versus China trade dynamics are going to play out. Obviously, there's the potential imposition of tariffs. I think digging certainly into, for example, the DeepSeek model, there was the initial headline that it only cost like $6 million to actually roll this out. As the headline started to walk back a bit, some interesting developments around that. That $6 million spend was actually the final distillation of the sort of last model before they rolled it out live. So certainly, I think as you relate that spend versus, for example, OpenAI's respective model spend, I think OpenAI's was like 15 million. So certainly a fraction of the overall spend there. But some interesting dynamics around the way in which China potentially used chips and got around some of these tariff dynamics, or more so just trade dynamics, was that they potentially rented space actually from servers in Singapore. And that will certainly be a conversation to come as it relates to how each of these different countries is rolling out their models, from an infrastructure perspective, what they're costing, but also as it relates to the overall intellectual property conversation. There are also some rumors and conversations that the DeepSeek model actually leveraged a lot of the proprietary IP underneath the OpenAI model. So basically they copy and pasted it. And no doubt they could roll out a much cheaper model because they leveraged an already really good one in OpenAI's.
Yeah.
Yeah, no, that's just one example of a risk to the current theme, and that's sort of the big picture theme.
Yeah.
I think of today's conversation is what could change, what is changing, and maybe the final quick question. I'll bring it back to Nick at Hurdle. Talk about how the globally diversified portfolios that you manage can protect against that shifting dynamic if it were to happen very quickly. And then perhaps we can open it up for questions from the participants.
Yeah, thank you. Once again, diversification, whether that's stock bond mix, whether that's active passive, whether that's growth value, whether that's US centric European stocks. We're obviously firm believers in that, right? It's one way to sort of build a portfolio that's resilient against a multitude of risks, whether it's earnings, whether it's the consumer sort of going into retrenchment mode and a threat to those earnings. But geopolitical risks, I think, are ever pervasive today, or it certainly feels that way. From our perspective, I grew up in the early 80s, so I think the Cold War comes to mind for us, the Sputnik moment that we just talked about, the escalating tensions between the China regime and the US, certainly front and center. I just look at this weekend when, if you're following the news, J.D. Vance gave a speech at the Munich Security Conference that I think caught a lot of folks by surprise. Here's a historic ally for us, and the U.S. put what, from our stance, and we talked about in the Monday morning meeting today, a pretty bright line in the sand, in the sense that this is a different environment that we're dealing with, right? So, what would you expect? You might expect in the short term European stocks to retrench. You might have expected European stocks to retrench since the change in administration in November, and that's the complete opposite of what's happened, right? So the idea of hindsight capital or perfect information, and then what would you have done with that information, often doesn't lead to sort of successful portfolio outcomes. So once again, it's why we believe in diversification. There's too many things that are going on for anybody to have 100% certainty on how to position the portfolio. It's why we're humble in what we do, and it's why we do things on the margin, and it's why we feel that diversification is a good sort of shield, I think, against overall market volatility.
Anything else to add from any of our other Medallion partners? Jim C., I know that you're here from Creative Planning and we haven't heard from you yet. Do you dare add?
Oh, well, thank you, Karen. And as always, appreciate being invited every year. It's really a pleasure to be a part of the conversation. And no, I mean, everyone else on the panel has really hit really well on all these different areas that we've talked about here today. I would just say with the AI theme bit is the one thing that's continuing to stick with me as we've talked through it. And I really do expect that what you will see is that how artificial intelligence starts to bleed its way into some of these other, maybe more traditional value companies. So if you talk about the AI theme, it started with the chips and the semiconductors in 2022, 2023. That worked its way into software last year. And then ultimately, as we look ahead here, where do we really start to see AI next? And how does it create efficiencies for all of the other companies in your portfolio, both domestically and abroad? And so, I think that it will be a situation where you have to listen closely to understand where it's happening in the different earnings and profits in the different companies that you own. Certainly, as Hurl pointed out, Nick had mentioned that, they kind of not turn away from it, but maybe add diversifiers across the non-Mag 7 positions. And certainly, we've seen their valuations really, really explode. And that's essentially a head start, right? They were first, specifically in NVIDIA as an example, first with these really powerful chips, but that's not a moat, right? It's a head start. Everybody else will start to catch up with that. And then, as Morgan brought up, you have companies like DeepSeek coming out and just finding a way for things to become more efficient. As we think about every bit of technology that we've ever seen, it's really, a game changer at the beginning, but then as efficiencies start to be created, it helps everybody. Price starts to come down, cost starts to come down, it starts to kind of blend out across everywhere else. So I think that the AI theme continues. It's just a matter of where it continues, maybe not necessarily in some of the usual suspects that we see. That would be the only thing I'd add. Overall, it's been a great conversation. Thank you again for inviting me along.
Anything else to add from our Medallion partners?
So
Jack.
one more just quick point here. I'm going to agree with everything that everyone said, including Jim. I think there's one sort of investment opportunity that's sort of under the radar, maybe not so much now, but AI requires a tremendous amount of power, electrical energy. So much so that you've probably seen the deal with Microsoft restarting the 3 Mile nuclear power plant. We saw similar deals with Amazon and Google out on the West Coast, building their own nuclear power plants. So if we're for investment ideas, maybe an indirect way to play the whole AI sort of development here is to look at old economy industries like industrials that feed into the energy infrastructure, the electrical infrastructure of our country. And it's not just AI, quite frankly, but cryptocurrency mining requires tremendous amount of electrical energy. The growth in electric vehicles. So there's this growing significant demand on our electrical grid that, quite frankly, needs significant investment. So if you look at possible opportunities, and we're very bullish on nuclear, we're very bullish on anything having to do with growth in the electrical grid, simply because there's going to be tremendous amounts of electrical power required for all these technologies, AI, EV, people, and so on.
Thanks, Jack.
Thank you.
Anything else to add? Anybody bursting to add something? Diane, Morgan, Mark, guess what? It's 12:59. The bells in the courthouse are going to ring in about 30 seconds. I think
Okay.
we've done it. What do you think, Diane?
I was going to say that as well, Karen. Everybody touched on really good topics. Nick about diversification, Mark about as the market's environments change, we're adaptive. Morgan, great call on the Sputnik moment, and that, you know, having a healthy competition isn't a bad idea for any company, even NVIDIA. And so we've done it. We've solved all of the problems of the world.
Oh, and lunch is up. Thank you for joining us today. And thank you for all you do, our investment partners, to help make sure that people's funds that we hold in trust are invested well for long-term perpetuity. That's a forever thing, you know, perpetuity is forever, as I said to somebody at the annual meeting. Yep, that's a long time. So we've really got an awful lot to deal with when it comes to the charitable sector and philanthropy. And we thank you for everything you're doing to help us grow philanthropy from the investment side, as well as our fund advisors who make those contributions and donations so that we can then help them turn them into great grants and scholarships.
Hey, Karen,
Yes, sir.
before you hop up, before you finish up, I just wanted to also, we didn't do this earlier, and I want to ask the staff to forgive me, but I would like to also give a thank you and a shout out to the staff of the CCF for all the work that you all do on a continuous basis. So thank you so much. Sorry to interrupt you, Karen.
No, it's good, Zeb. Thanks to staff, thanks to the investment committee, thanks to the board, thanks to the investment partners, fund advisors, everybody. So, and I hope to see you all at Sweet Charity in another week or so. Go to Downingtown Country Club, just show up. We've got all kinds of networking and some terrific desserts. So please, sweet it is. If you have individual questions that you'd like to address, we can stay on the Zoom. And otherwise, it is 1 o'clock and we like to be on time and honor your time. So thank you for everything you do. Please keep in touch.
I have a question.
Yeah, Tony.
My name is Tony Simkovich. I'm with the West Goshen Lions Club. I've been in Westchester for 40 years and have a question regarding a concept that's used in investing called socially responsible investing, which seems like an oxymoron compared to the Mag 7 and the AI stuff that's going on in the marketplace. Have you folks come across any success stories at all where there was a balance of a good investment and a decent return, or is that considered an oxymoron?
Yeah, that's good examples. Mark, you want to give it a start?
We'll start from a high level. I think it's a great question. And the rise of socially responsible investing or mission-related investing or a whole bunch of other terms that have been associated with the same idea. The evolution of this business, I think there's a couple ways of looking at it. Honestly, you can look at it from a political perspective, which we don't think you should do, but from sort of an economic and an earnings perspective. So if there's a way to make something more efficient, to make something with less impact on the environment, or make it more effective in the community, that should drive earnings, and that earnings should drive stock prices. And I think you can find investments that have those two characteristics together. I think you have to be careful, though, that if it's a blanket approach, just they call it greenwashing in the industry, which is basically just try to be environmentally conscious or socially conscious without a focus on the economics. I think it's a danger, because you sort of mix and miss the point of investing with that framework. So I have seen success stories in that area, but you have to be selective, you have to be careful, and you have to understand the balance of and the trade-offs effectively between what you're investing in and what your mission is. And as long as they're coexisting, which I think you can find, there are success stories out there.
Do we have that as part of the portfolio? Any success stories?
We as a community, as a group, we do not invest with any specific socially responsible focus, only because it's a commingled portfolio with a lot of different perspectives in it. So today we think of good governance, and good governance can be how the management of the company and the boards of the publicly traded companies, they manage their businesses. But we don't have any overriding themes or tilts driven in the portfolios today to meet any particular social responsible investing theme.
And just a follow-up question, quick. With the government cutbacks that are coming down the pike, and also I think people have been living off their credit cards since COVID. I think people are maybe at the breaking point. I don't think these folks are going to find jobs in another government somewhere, at least in the short term. And with a trickle-down effect from these people losing their jobs, and then a trickle-down effect to state and local because of funding, I can see an increase in the unemployment rate. Hopefully not a big one, but we're going now in the other direction. We've gotten so far for full employment. Now we're going the other way. How does that impact your how you look at opportunities and investments that are out there? People are going to have less money. They're not buying the stuff that they might have before. In theory, how do you handle that?
Great question. I might ask members of the group here online to comment. It affects economic growth. It affects unemployment, as you talked about, and those are all pretty critical in terms of making sure that the themes in the market stay as is. But I don't know, Diane, do you have a thought on that?
Well, Tony, as you brought up this question, it made me think to share. There are so many moving dynamics, and staying with the current administration where there are layoffs in one area, the government, but we also have planned, if not already enacted upon, deportation of within immigration. So you'll see folks leaving our country who may have very well had jobs at a certain level. Now the skills might not match, but it's almost that creative destruction going on where you've got folks looking for a job and maybe jobs suddenly becoming available. So I don't know that there's a perfect answer to that question. There'll be a lot of tension and uncertainty between those two dynamics.
Well, I think where I was coming from was I think the core things that's been keeping this economy running and maybe masking some problems is consumer spending. Less dollars in people's pockets by definition is probably less consumer spending. So what's the alternative if we're not spending like we used to?
Yeah, consumer spending represents about 2/3 of economic growth in the United States. It is the dominant factor.
Right.
And government spending is unlikely to go much higher because we're spending on our own U.S. credit card, if you will. Our combined debt to GDP is already quite high. So I don't think there's a lot of scope there. So I do think at the margin, more unemployment, if it sticks, will drive less spending, and less spending could turn into a economic slowdown that, if you combine tariffs with it, could result in a fairly recession. So I think you have to be careful about, even though there are themes that should be positive for the economy, there are definitely some risks out there, and that's why we talk about such a balance of risk and return in portfolios.
Great. Hey, thanks, folks. Great presentation.
Thanks for bringing up the questions, Tony.
Yeah, thank you.
Anything else for the good of the order? We have a great deal to do. Thank you, everybody, for joining us today. And we'll stop the recording, Beth Kay. And if you have individual questions, please stand by. But please feel free to go out and do amazing things because we need it. Thank you, everybody.